If you want to know which way the stock market is going to move this week, whether it's going to go up or down, don't ask me because I don't know. This week is full of major economic news that's going to move the markets and cause a lot of volatility, meaning there's going to be some days where the market's up 1 or 2%, and there's going to be other days where the market's down 1 or 2%. All I can tell you is this is going to be a very volatile week in the stock market. Now, of course, if you're a long-term investor, you don't really care. You're just going to keep dollar cost averaging into the stocks that you like. But for a short-term trader, this week is going to provide some incredible opportunities to make money in the stock market. So let's talk about what's going on. For long-term investors, you need to know what's happening this week because some of the economic data that's coming out this week could affect the stock market for many months to come. As a short-term trader, you definitely need to know what's going on this week so that you can take advantage of all the different trading opportunities that this week is going to provide. Now, for long-term investors, I do just want to talk a little bit about what the market normally does over the month of August and then into September and also October. So during the month of August, the stock market is historically flat or slightly down. This month, the first 3 weeks, the stock market was down quite a bit. But then last week, we recovered a little bit. This week, at least probably through the end of Tuesday, we might continue that recovery. But then after that, we get into September. And September is historically the worst month of the year for the stock market. So if you thought August was bad, just hold on, because September is historically horrible. Now, just because September is historically a horrible month for the stock market does not mean that we're going to enter a new bear market. It does not mean the stock market is going to crash. It just means that the stock market historically goes down. Now, for a long-term investor, this is a huge opportunity to buy the dip and get all of your favorite stocks at huge discounts next month in September. For short-term traders, it's a huge opportunity to possibly buy some put options on the market or do other bearish plays where you can make money as the stock market goes down. So whether you're a short-term trader or long-term investor, you should be looking forward to a downturn in the market in September because this is a huge opportunity to make money. Now, if what I just talked about with put options and making money as the market goes down, if this just doesn't make sense to you, don't worry. In the description of this video, I have a course where I teach you how to make money in the stock market. I'll teach you options. I'll teach you the basics of the stock market, how it works. I want you to be able to retire wealthy. I want you to be able to quit your job, fire your boss, retire, live off of your investments. In order to do that, you've got to get started and you've got to know how to make money no matter which way the stock market goes. It's not just about buying stocks and hoping they go up. There are ways to make money as the stock market goes down also. So if you have no clue how to do that, you want to learn and you want to make money, check out the description of this video where I've got a link to my course where I will teach you how to make money in the stock market even as it goes down. Now, longer term, come October, there is a great time because October historically is where the market bottoms out and starts rising. Think about last year. We had a major bear market from January to October. And what happened in October? The market bottomed out and it went on this massive rally. So even if the stock market does continue to go down for August, even if the stock market does go down significantly in September like it historically does, October is the bottom. And October is where we historically have seen the stock market restart the rally and restart the bull market and continue to go higher. So whatever downturn we get is going to be temporary. It should be very short term. So look forward to it. Enjoy the opportunities to make money. Now, let's talk about all the economic news that's coming out this week so that you can get prepared for some of the things that might cause the stock market to go down in September, but also so that you will know what's going on so you can have some short-term trading opportunities as well. To start understanding what's going to happen this week, we've got to go back to last week and talk about what happened on Friday. On Friday, Federal Chair Jerome Powell spoke at Jackson Hole, which is the Fed's annual symposium. And he basically said that inflation remains too high and that the Fed was prepared to raise rates further. Jerome Powell said that although inflation has moved down from its peak, which is a welcome development, it remains too high. Jerome Powell further said, "We are prepared to raise interest rates further if appropriate, and we intend to hold policy at a restrictive level until we are confident that inflation is moving substantially down towards our objective." What Jerome Powell is essentially saying is that while inflation has come down, it's nowhere close to where it needs to be. And actually, last month it started moving back up again, which was not a good sign. So Jerome Powell also said two other things. He said that the Fed might continue to raise interest rates this year. And Jerome Powell also said that the Fed will not cut rates anytime soon. Now, the bond market realized that Jerome Powell is probably speaking the truth. And if you look at the interest rates on the 10-year Treasury and others, you see that those rose after Jerome Powell spoke. But the stock market continues to believe that Jerome Powell's lying. Even though futures traders have started pricing in another rate cut this year, and future traders have started declining their expectations for a rate cut this year, and they're expecting a rate rise, futures traders get it, bond traders get it, but stock market traders don't. And this is going to cause a problem at some point. One analyst at the Wall Street Journal said, despite what Powell says, the Fed is likely done. And this is the general belief among stock market investors, is that the Fed is not going to raise rates. And in fact, not only are they not going to raise rates, they're actually going to cut them. Now, this would essentially make Jerome Powell out to be a liar. It would make bond traders out to be idiots. So it would make futures traders out to be idiots. So either Jerome Powell, the bond market, and the futures market are all wrong and the stock market is correct, or Jerome Powell, bond traders, and futures traders are all correct and the stock market is wrong. Somebody's wrong. Somebody has to give. Something's got to give here. And as a result of the stock market thinking that everybody else is wrong and everybody else thinking the stock market is wrong, well, this leaves investors with a cloud of uncertainty. And the problem is the stock market could face a very difficult week ahead. As the stock market moves past the Jackson Hole Symposium on Friday, the reality is the biggest event for the markets is always the next one. Meaning everybody looks forward to some big event such as Jackson Hole, but then as soon as it's over, the market immediately starts looking at the next big event, the next economic news that's coming out, the next earnings, the next thing that's going to move the stock market. And nowhere is that more true than what's coming out this week. With second quarter earnings reporting season coming to an end, major economic data in the coming days will provide some guidance on the resilience of the U.S. economy and whether the Fed will raise interest rates further at its September 19th to 20th policy meeting. Now, based upon what the Federal Reserve has said and based upon what futures traders and bond traders are pricing in, the Federal Reserve is not expected to raise interest rates at the September meeting. They are expected to do another skip. This is the new thing the Fed is doing. They're raising interest rates by 0.25 percentage point every other meeting. They just did a raise, so September meeting they're expected to skip, and then they're expected to raise rates again at the meeting after that. Now, still, when the Fed does skip, the stock market is expected to rally. The stock market's going to be like, yay, the Fed is done raising interest rates. Bye, 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 bye. But at some point, the stock market then wakes up and is like, oh, wait a second. No, they're not. They're actually going to raise rates again at the next meeting. So this is just the games we play. You just got to deal with it. So the stock market is expecting the Fed to not raise rates in September. On that matter, I think the stock market has it correct that the Fed is not going to raise rates at their next meeting in September. But I think the stock market is wrong that the Fed is not going to raise their interest rates at all this year. I think that's where bond traders and futures traders have it right. I think that's where Jerome Powell has it right. That while they are going to pause in September, they are also going to raise again at the meeting after that. So this is something that the stock market is not yet priced in, and it might cause a little bit of downward pressure on the stock market. Short term, though, we've got to focus on what's happening this week and this week's major U.S. economic reports. Now, while there's not much happening on Monday or Tuesday, Wednesday is when we kick off the major economic reports this week. And Wednesday, before the market opens, we have the ADP jobs report. The ADP jobs report gives an indication of where private payrolls are. And the big thing to look at here is that in July, private payrolls rose by 324,000 jobs, but in August, they're only expected to rise by 170,000 jobs, meaning that investors are expecting a major decline in the job market. Of course, if the job market declines too much, then we enter a recession. Thursday also has its major economic news, and that is the Personal Consumption Expenditures Index, or PCE, that is coming out at about an hour before the market opens. And the big thing to watch out here for is the core PCE, because that is what the Federal Reserve uses to determine whether or not to continue to raise interest rates. And the big concern here is that core PCE is expected to have gone up, meaning inflation is expected to start rising once again, which is not good news. Then on Friday, we wrap things up about an hour before the market opens with the August jobs report. And this is where the expectations just don't make sense. On one hand, the number of jobs gained is expected to decline from July, but on the other hand, the unemployment rate is also expected to decline. And that just doesn't make sense. If the number of new jobs created goes down, then unemployment should go up. So something has to give here. Something is wrong. Then on top of that, the U.S. hourly wages is also supposed to go down. And that is not good news because personal spending is expected to go up. So if people are spending more but making less, that is going to end up resulting in disaster for consumers. So the economic news on Friday is really uncertain because what the expectations are coming in don't line up with one another. So either the official jobs number is going to come in much better than expected, which would cause the market rally on Friday, or the official numbers are going to come in much worse than expected, which is going to cause a major sell-off on Friday. I don't know which way, but Friday we should get some pretty big volatility in the market. Of course, Wednesday and Thursday, we could get volatility as well. Now, the reason I'm sitting here just completely unknown as far as which way the market is going to go really has a lot to do with market psychology, market sentiment. See, in a very bullish market, in a very greedy market, you can expect the stock market to go up no matter what the news is. On the flip side, in a very bearish market, in a very fearful market, you can expect the market to go down no matter what the news is. But right now, we're neither bullish nor bearish. We're neither greedy nor fearful. We are literally sitting at neutral at 48 on CNN's Fear and Greed Index, making trying to predict how the market is going to respond to this week's news completely impossible. Now, while that's all the news that short-term investors really need to focus on this week, I want to switch back to the long-term outlook because the long-term outlook continues to look pretty bad for stocks. And this is really expected to help accelerate that September sell-off. So if you're looking for a reason why stocks might go down in September, well, let me give you a reason right now. Rising long-term interest rates loom over Wall Street. Futures markets show a growing expectation that interest rates could stay higher for longer, as Jerome Powell said they would, and that could exert downward pressure on stocks. The question becomes, at what point does the bond market provide competition to the stock market in the eyes of investors? See, while the stock market will generally go up by about 8% per year, the bond market is currently pricing in anywhere from a 4 to 5% yield. And that means that a risk-adverse stock market investor might look at the stock market and say, I can maybe make 8% per year, or I can go buy a bond where I'm guaranteed to make 4 or 5%. And if inflation is only going up by, say, 4%, and you can get a bond that's guaranteed to make 5%, well, you're guaranteed to make money. So a risk-averse investor might look at the stock market and say, I don't want to risk an 8% possible return as well as a possible downturn if I can go buy a bond and be guaranteed to make 5%. And so at some point, the bond market might become more attractive to investors than the stock market. And if that occurs, then money flows out of the stock market and into the bond market. And that means bond prices go up and stock prices go down. In addition to that, the crippling shift in the rates picture coincides with signs that the AI trade is fizzling. NVIDIA, the graphics chip maker at the heart of the AI boom, gave another blockbuster forecast on Wednesday while reporting record sales for the latest quarter. But the numbers failed to power a broader market rally. And the AI boom fizzling could also put downward pressure on the stock market as investors start to sell off the overpriced stocks that rose on nothing more than AI hype. The recent climb in long-term bond yields, meanwhile, has accentuated concerns that the stock market as a whole is trading at lofty valuations that leave it vulnerable to disappointing news. That is especially true, many investors argue, given the recent climb in long-term interest rates. The yield on 10-year U.S. Treasury notes rose to as high as 4.34% in recent days, to its highest settle since 2007, right before the great financial crisis. Rising yields drive up borrowing costs throughout the economy and tend to reduce the prices that investors are willing to pay for investments such as stocks. Rising interest rates threaten share prices by offering investors a competing way to earn a return. A major shift in the financial landscape after 13 years of rock bottom rates that have led many to believe that there was no meaningful alternative to stocks. But now there is an alternative, and that is bonds. Higher rates also ding the worth of future earnings in widely used pricing models, meaning discounted cash flow models and other valuations mean that the actual valuation on stocks has to come down. And the result, if the market accepts those trimmed down prices, would be stocks trading at lower multiples of their projected earnings. In other words, stock prices going down. The broad stock market index is trading at 18.6 times its projected earnings over the next 12 months, and that is up from the 16.6 forward projected earnings that we had at the start of the year, and it's above the 15.8 multiple at which the stock market has traded on average over the past 20 years. One of the major reasons for the stock market trading at such high multiples was the tech rally that occurred throughout the end of 2022 and into 2023, and that has left multiples extremely high. How high? Well, the stock market is currently trading at about 15% above its average based upon expected future earnings. So if the stock market were to get back down to the average price that it normally trades at based upon future earnings, the stock market would have to fall by 15% just to get down to average. Now, you're probably sitting here saying, well, wait a second, Scott, we already had a major downfall in 2022. I thought we were in a new bull market. I thought we were rising. I thought everything was good. We were in a new bull market and we're just going to continue to go up. Well, here's the problem, is that earnings have actually gone down. The amount of money companies are making across the board is declining. And as earnings go down, stock prices are supposed to go down also, especially considering the fact that future earnings are also expected to go down. So as earnings go down, stock prices should go down, but they haven't. They've actually gone up. So we're in a weird situation where earnings are going down, but stock prices are going up, and this has created a very expensive stock market. And that is why the stock market would have to fall by about 15% just to get back down to the average price that investors normally pay for future earnings. So long as the stock market remains elevated where it currently is today, there is a major risk of a significant downturn in the stock market. And that risk makes many investors concerned, which in turn could cause people to pull money out of the stock market over concerns that it might go down. And all that money coming out of the stock market over concerns the stock market might go down might actually trigger the stock market going down. And this is one of the major concerns that a lot of investors have right now, that these extremely high prices investors have paid are not going to last, and that we're going to be in a situation that we were kind of in early 2021, where stock prices were really, really high. And when they came down, a lot of investors ended up losing a lot of money. So I don't want you to be in that situation where you lose money if the stock market goes down, especially considering everything that's going on right now in the historicals and how September normally performs. I want you to be in a situation where you can actually make money if the stock market goes down. So if you're not sure how to make money if the stock market goes down, please go check out the course in the beginning description of this video. I really, really, really want to help you make money as the stock market goes down, because there is an incredible opportunity to make a ton of money over the next month if you know how to do it. Now, let's wrap this video up with the earnings that are coming out this week. There's not a whole lot, but there are a few you might want to know about. Tuesday before the open, we've got Neo, Best Buy, and Pinduoduo all reporting earnings. And then Wednesday after the close, we've got CrowdStrike and Salesforce. So like I said, earnings season is pretty much over. Not a whole lot of major companies reporting earnings, but there's still going to be a few here and there to keep your eyes on. Now, if you got a lot out of this video and the video really helped you out a lot, make sure you hit the like button and subscribe, and be a good friend and share this video with your friends and family and on your social media pages so that others will know what's going on in the stock market as well. And if you missed the video that I put up last week explaining some fundamental analysis on NVIDIA, a lot of people didn't like it because they just think that stocks are just going to go up forever. But if you want a reality check and you want to know what's really going on with the fundamentals of NVIDIA, make sure you watch the last video that I uploaded here.